Today's webinar, valuable reports for your business. My name is Roger Swift. I'm with the Central Texas Small Business Development Center. Today is National Food Day. I guess we want to make sure we're not wasting any food and taking advantage of eating a lot of food. I'll try to be doing that later. We are the SBDC is a leading provider for assistance for small businesses. We are grant funded, which allows us to bring our services to you at no cost. A quick reminder, today's webinar will be recorded and added to our YouTube channel. It is interactive today, so if you have any questions, just use the hand at the bottom of the screen to raise it or unmute yourself and ask your question. Our presenter today is Bryce Forney. Bryce is a Bay Area sole prop CPA preparing tax returns, mostly for business owners who use CloudBooks for their businesses. He's an understandable, likable, mobile accountant working in hotel lobbies, libraries, and liquid spaces. Welcome, Bryce.
Thank you. I'm going to go ahead and share, which is the most challenging part. Hopefully now you can see the title slide.
Yep, we are good.
Great. And with that, of course, just another reference to, as a small business owner, use your resources, and the SBDC is there for you, particularly the North Central Texas SBDC. And just a quick introduction about me. My name is Bryce Forney. I am a CPA and I prepare tax returns for a living. As Roger mentioned, I work in a lot of mobile spaces. I was in a Courtyard Marriott hotel lobby yesterday, and I work at a local Capital One cafe quite a bit of the time. I really like the Courtyard branded Marriott hotels because this isn't very well known. I don't know why, but they offer free Wi-Fi to anyone in almost all Courtyard locations. They actually promote it as a benefit. So it's a very easy place to pop in and get some work done, at least for me. So it's a strange thing for me. For some reason, I'm more productive in hotel lobbies, and Liquidspaces is just an app I use to get space on the fly, to get office space. So enough about me. Let's move on to talking about the numbers analysis for you as a business owner. So you have a lot of responsibilities as a business owner. And what I want to focus on today is how you can analyze your financial information to get really valuable insights for your business. So this is about reporting, but really specifically, it's about getting really good information so that you can make better decisions for your business. So this is all about you and your ability to get better information so that you can make good decisions about pricing, about costs, about overhead, anything that's going to hit your profit and loss statement. And may touch on a balance sheet at the tail end of this, but most of the focus is on managing the money in and the money out. So these are some of the questions that you probably don't ask because the phrases, the terminology may be unfamiliar and it may not resonate with you. So my hope is during our session today, these will become familiar and become something that you want to start to look into, because your books, the reporting out of your books is some of the most valuable information you can look at. Of all of the indications that you get from customer feedback is obviously number one, but in terms of analyzing how successful your business is, there's only one source, and that's your books and your reports. So we're going to start by talking about gross profit and then go into some of these other questions that hopefully you're thinking about asking, or maybe you have asked and you really just didn't put it in these terms. So I'm going to hope to go through the terminology in a way that's understandable. So let's start with gross profit, otherwise known as gross margin. Those are the same thing. And if you put it as a percentage, it's your gross profit percentage. Those are all the same term. And we as accountants like to come up with fancy terms for simple things. And so my hope here today is that you'll understand just what these terms mean, because it's so valuable for any business, whether your services or product. So in order to calculate, well, let's talk about what gross profit is. Gross profit is your total money in less the direct cost of producing that revenue. So for the easiest way to look at gross margin or gross profit is a retail store. So my dad used to own a hardware store, a True Value Hardware. I'm sad to see the True Value is going bankrupt, but in any case, the gross profit was the total money the customer paid for a given product. Let's say it's a wrench, and you subtract the direct cost, what you bought the wrench from the warehouse for at cost. So at that time, the margin for most of the products was somewhere around 25–30%. The one big exception was keys. Keys were almost entirely profit. There was almost no cost to the actual nickel-plated brass that the keys were made out of. So that was really profitable. But on most items, you're targeting 30%. Tools were extremely low in margin. So with a wrench, the customer would, let's say, pay $10 for that wrench. And the hardware store would typically buy the wrench from the distributor for, let's say, $70. So that's the direct cost of that wrench. So you take the $100 purchase price, or sales price, less the $70 that was purchased, and you end up with $30 of gross profit or gross margin. So that gross profit, that $30, can be divided into the total that the customer paid. And there's some misunderstanding about markup and margin, so I'm going to clarify that. But with our example, I think I switched from I said the sales price was $10, and then all of a sudden I went to 100. My apologies. Let's stick with the $10. So you sold the wrench for $10, you paid $7 for it, you have $3 of gross profit. That $3 divided into the $10 sales price is your gross margin, your gross profit percentage. So the $3 over the $10 is a 30% margin. So let me distinguish between margin and markup. They are two entirely different things. Margin is what I just talked about. It can never be greater than 0.99999. It can never be 1, because what you gain on a sale necessarily cannot be more than 100%, because your profit on it cannot be more than 100%. So markup, by comparison, is a multiple of what you paid for the product. So in clothing, for example, there are tremendous markups depending on the brand of the clothing. So it would not be uncommon for a clothing retailer to pay $10 for a given apparel item and be selling it for $100. So they could have a 10 times markup. That's different than their gross margin. If we use that same example of where they're going to sell it for $100 and they paid $10, their gross profit is $90. That $90 divided into the $100 that they sold is still a very healthy margin, but it necessarily cannot be greater than one. So that's kind of how you know margin as opposed to markup. Those are two different things. And I mention that because markup is used quite a bit in conversation about, well, I buy it for this and I sell it for this. So, so they think about their, one way to look at things is to think about markup. But margin is the important profitability metric from an accounting standpoint. And margin can be measured by industry, essentially. So you can find out that in the grocery store business, margins are very low. They're in the single digits for most of the items that are sold within a grocery store. In a hardware store, I think it's still going to be in the 20-30% range. Retail is like that in general. And then some retail has very high gross profit. Typically, the higher the price of the item, if you're in diamonds or I should say jewelry or luxury apparel, where you walk into the store and you only see like 3 items on the shelf, those kind of places typically have exceedingly high margins, and they need to because they're not moving units like a more typical retailer. So in any case, that gross profit or gross profit percentage, those are just two different ways to measure the same thing. What is your gain after you've sold your product to the customer and subtracted your cost? So that's your gross margin. And you might think, well, I'm a service business. I don't really think about a direct cost of my revenue. If you're in a service business, you still do have gross margin. It may be very, very high because you have very few direct costs. But one example of a cost that is a direct cost, even for services business, would be the cost of getting the money in. The merchant services paid for a credit card or whatever bank fees apply to getting the money into your bank account. You may be in a business where you don't have any of those costs, but most businesses do. So using the merchant fee as an example, let's say a merchant is paying 3.5% on credit card sales. That is a direct cost because as the revenue goes up, that cost also goes up. And I mention that because if you're in a services business, you may have some costs that you don't really think of as direct, but in fact they are, because the more revenue that you have, the more of that given cost that you're going to have. It may be that for an architect, that architect has subcontractors who are doing the work, typically hourly. So there may be a direct cost in terms of hours that are invoiced to the customer as compared to hours that are paid to a subcontractor. For a construction contract company, the labor that is used to build or remodel whatever kind of construction company it is, the direct cost of the labor of the people who are generating the building or performing the remodel, that labor is a direct cost because it's directly tied to the revenue. There are a lot of different ways for contractors to price jobs, but just to keep it simple, if it was a cost plus contract where the actual cost of labor and then some 15% margin is added, then those direct labor hours, including the burden on payroll for payroll taxes, benefits, that sort of thing, those would all be direct costs because as revenue goes up, that cost also goes up. So it's important to know what your gross margin is because Gross margin tells you basically what your break-even point is, in the sense that you've got those direct costs, and then the only other category of cost is overhead. And that's just a fancy term for costs that don't change based on a change in revenue. So the rent for a commercial building is not going to change no matter how much revenue you have. I should say there are some landlords that tie into gross receipts if they have a really confident knowledge about what sales are going to be. If there's a Jamba Juice coming in, they might attach to sales and say, okay, we're going to take 3% of sales, because they know that's going to work out better for them. But most landlords are going to rent for a price per square foot, essentially. So those are overhead expenses. They don't change no matter what happens to revenue. Other examples of overhead expenses are anything related to operating an office, whether it's the technology equipment that's employed, the furniture, communication related devices. All of those elements are essentially, I mean, there's some relation. A business isn't going to buy a tremendous amount of furniture if it's not going to have the revenue to support it, or it shouldn't. But in the case of an expense, it's a direct cost. If it goes up, as revenue goes up, and it's an overhead expense if it stays the same regardless of revenue. So determining gross margin, the profit that you make after direct costs, is important, because then you can measure that against your total overhead to know, where am I breaking even and where do I start to actually make money? So we've got an example to follow, but I just want to go through some of these other elements that are important that come out of knowing your gross margin. So it's also important to know gross margin so that you can determine what compensation you want. So if you know your gross margin and you know your overhead expenses, you can then know what level of revenue gives you the salary or owner compensation that you're expecting out of the business. You can also determine, if you have gross margin, how much more you're going to make if you increase prices and or decrease the direct cost of selling. Another major direct cost of selling, whether it's products or services, is sales commissions, an exceptionally valuable direct expense to get compensation to the salesperson who has convinced the buyer to buy the product or service. So knowing gross margin, you can also, as I mentioned before, compare it to other metrics for your industry to know whether you are more or less profitable than the benchmark. So let's go through an example of gross profit, just so that you can apply some numbers to this somewhat theoretical discussion. So let's say that you are an auto repair shop, and you know that for parts, you want to have a 20% margin. And by the way, a calculation that you can do is, if you're targeting a given margin level, you can divide what you pay for the product by 1 minus the margin that you want to receive. And in this case, if we want a 20% margin, then we divide by 80% to the cost that we have paid for a product to know what the sales price is going to be. So there's a little inside baseball for how we get to sales prices based on knowing what we're paying for a given product. So for labor in this hypothetical auto repair shop, you're paying $55 an hour in wages, which works out to be about $65 an hour with the payroll taxes and the benefits. And you already have a set price that you're selling the services to customers for $115. That's what the hourly rate is. And the reason we know that price, as opposed to being able to calculate a margin like with the parts, is that in the auto repair business, typically, insurance companies are heavily involved and they have a set price or a maximum price that they're willing to pay for labor hours in exchange for getting all of their work. So a lot of auto repair shops are in service to insurance claims. So that's what we know about this business. And we also know the mix is of services to product is 75% labor and 25% parts. So we also have some other overhead costs. We've got rent, office costs, utilities, and on an annual basis, that costs us about $425,000. So we know we have a 20% margin on our parts, and we're going to calculate our gross margin on labor. It's calculated here. We have a 43% margin on labor. For every dollar that we sell in labor, we're going to come away with 43 cents after our direct costs. So the rest of the calculation is there just so that you can play along at home. And then let's go to a couple of benefits that we know because we've calculated our gross margin. We know that we're going to break even at if we sell $843,250. It's a little bit different of a number. I rounded a little bit to make it relatively even. But what that means is with this mix of labor and parts, given those margins, our overhead costs are $425,000. So we need to sell $425,000 in labor and parts just to, we have to get over that hurdle. That's an actual cost. And then of every dollar we sell, we're not making all of it in profit. We're making somewhere blended in the 43, 20, let's say it's probably about 30%. It's probably a little higher. It's probably like 35% overall margin. So the calculation's accurate. I'm just trying to work into how we get to that $843,250. So we need to sell that amount. We're making, if we sell $850,000, we're probably making, we're making a higher margin then. That's the case. It must be closer to 40% in overall margin. I'm just thinking out loud. This is how we accountants do this. So, but nonetheless, we know that we need to sell $843,250 just to break even. At that level of sales, we have covered all of our overhead costs, but we have not actually made any money in terms of compensation to ownership. We have compensated our laborers for the hours that they've worked and benefits. So getting to that $843,250 is important, but the dollars above that are where the owner starts to have compensation. So, for example, the second item there that we can elicit out of this is if the owner wants to have, let's say, $150,000 of compensation, then the owner knows that they're targeting a sales level of around $1 million. They're going to get a little bit more, but you get the idea. So you can know what level of sales you absolutely need just to break even. That's an important consideration, even though it sounds silly. Why would you want to calculate what you need just to break even? But it's important to know what you're doing to cover your overhead costs. And going back to the hardware store that my father owned so many years ago, he had actually calculated his break-even point, and it was something, the dollars aren't really relevant because it was so long ago, but he knew that in the wintertime, particularly for hardware stores, once the holiday season is over, January and February are very difficult months, at least here in the San Francisco Bay Area. And it is often the case on many days in January and February that you can't even get to break even. You make up for it in the spring and summer and through the holidays, but the lean months are January and February. Knowing his break even would be able to, was information to him to know, okay, I'm short whatever it was. Like I said, the numbers are so far away. I don't even want to mention them, but you know, he could say, okay, I'm $750 short today, which would be the equivalent of probably $7,500 today, below break even, and then know that in March and April, when there was a surplus above break even, he was still effectively even, and then he knew when he was in the black. In the black as being profitable, in the red as being in a loss situation. I think that's a familiar phrase because of Black Friday, which is the time that retailers typically start to become profitable the day after Thanksgiving. It's when they become in the black because so much of sales in the United States is around the holidays, which is why we see stores merchandising for the holidays now in late October. So another metric, so that's gross margin. That's going to tell you so much about where your break-even point is, what your compensation is going to be, and making sure that you can cover overhead costs. I wanted to handle that one first. That is definitely the most in-depth analytically. And then there are some other metrics that you can use. Another one that's really simple is comparing net income to total sales. So this is a very simple calculation, and it doesn't have the same depth of the gross margin analysis, but because it's simple, and particularly in cases where it may be difficult to determine or accurately determine what the direct cost level really is. So maybe it's just unclear or takes more time than it seems worth to carve out what are the direct labor costs and what is overhead. So in those cases where you have nothing else, you will always have net income as a percentage of sales. So as mentioned here, it's a flawed metric because this is not something that you can do across, I mean, any industry can perform this analysis, any business can perform this analysis, but there's not a lot that you can really glean from it other than saying, for every dollar that I sell, this is the amount that I'm going to make. So if you've got total sales of $100,000, you've got costs of $10,000, that $90,000 of net income in relation to the $100,000 in sales says, yeah, about 90% of what I'm selling is going to become profit. That's an unlikely scenario in reality, but this is something that micro businesses can use as an analytical tool, particularly when, as I mentioned, finding the direct costs and carving those out are going to be difficult. So let's go through an example of net income to sales. So we've got a sole practitioner architect with $300,000 in sales and $75,000 in total expenses. So net income to sales is 75%, which is actually relatively common for small service-based businesses where quite a bit of the gross revenue, the total money in, ends up becoming net income with lean, relatively inexpensive costs. A a sole practitioner architect, particularly if they do not have commercial space to rent, is going to be able to get this kind of net income to sales in the 75% range. So that's a great example. If this same architect were to rent space and have a commercial office, that net income to sales could easily go from 75% to 25%. Rent is a tremendous expense for most businesses, particularly small operating services businesses. So, but it's important for an architect, maybe particularly. So, using this example, this architect can know that if he or she sells an additional $10,000 of revenue, that owner compensation of that is going to be $7,500. Almost all of that is going to come back to the owner. So that's a net income to sales percentage. So switching gears, so those are doing gross margin to doing gross margin analysis in all of its forms, or comparing net income to sales are great metrics where you can compare your results against other similar companies, particularly the gross margin. Another tool that you can use in terms of gathering information from the reports in your business books, when you do a profit and loss, you can identify large expenses and question how valuable those are to your business. Now, there's sort of a opposite situation in small businesses where you see large expenses on the P&L. Those are on the profit and loss statement. Those are typically not really controllable, important expenses. And yet in large companies, public companies, when you see large expenses, oftentimes that can end up being a source of waste where they are controllable, unnecessary expenses. So I'm going to just speak from the small business perspective. If you've got a large expense, you've probably determined that you need to incur that expense. So for a small business, if you see a large expense and you know what it is and you know that it's necessary, well, then don't spend a lot more time on it. But there may be other categories that appear large or unusual where you really should question, what is the benefit to my business? Some of the, as we like to say in the industry, some of the categories where the bodies are buried would be miscellaneous expense. In my opinion, you shouldn't have a miscellaneous expense as a category, but things can get dumped there. Miscellaneous expense, office expense, and supplies expense are just some common categories where some expenses can get buried, particularly if you have someone else, not someone else doing the books, but someone else involved in actually purchasing items, whether it be office supplies or supplies for the business. There can be accidental additional purchases or intentional additional purchases that may not be entirely beneficial to the business. So those are good examples. You should know all of the categories of expense, why they are what they are. You should know that, what your utilities expense is, and the report that you can run so that you can see these expenses. One is to run the expenses by vendor report. And the reason I mention that is when you run a profit and loss report, it'll have a total category, a total expenses by category. But you may not think about expenses by category. You may really think about expenses by vendor. You may think, well, I know I pay the mobile phone company for the services and the phone. I don't really know where that goes on the profit and loss statement. Bookkeeper's in charge of that. I really know it by that vendor, whether it's Verizon or AT&T, T-Mobile, whatever. So you may want to run an expenses by vendor report to get that information, and then you can sort that report by amount. So whether you use a profit and loss report that shows it by category or an expenses by vendor report, that'll give you great insight into possible expenses that are unusually high or expenses that you might consider you can do without. So removing expenses from the profit and loss statement is a major way that you can improve the bottom line. And then the final thing to consider with respect to analyzing your profit and loss statement is, and this is another thing where for a large business, growing revenue can be very difficult because in large businesses, with public companies particularly, they're already highly successful at getting customers to subscribe to their service. Their offering has already met the needs of millions of people, and that's why they're a public company. So for that company to say double revenue can be kind of ridiculous because they've already tapped into the market. They have pretty much perfected who their customer is and identify their needs. They've got the product at the right price. For a small business, it's exactly the opposite. A small micro business has the opportunity to double or triple revenue just as willing as the business owner is to market and sell the services or products that they're offering, because there's so much of an addressable market that is simply unaware of small businesses. Like I think about the town nearby where I can drive down the street and see 20 different stores that I've never heard of. I don't know what they sell. And in a way, if those businesses have services or products that are valuable to me and they can get me aware of them, then I'm going to be a willing customer. So in growing your revenue as a small business, the best thing to do is interview your customers, which can also be, it can feel unusual to be asking your customer about why they're buying and why they're buying from you. But those are essentially the questions. And if you can tease out specifically why they're buying from you, if you're selling something in a highly competitive market, then what kind of I think of Warren Buffett's phrase, what kind of moat you have around your business, what makes your distinct competitive advantage, and then you can communicate that in your marketing materials. So another question to ask customers is, if you had more to offer, would they buy more from you? And importantly, at what price would they buy more? Because it's easy for a customer to say, oh yeah, I'm really happy with you. I definitely buy more. But then you mention, a price point and the customer's all of a sudden like, whoa, wait, I'd like to buy a little bit more, but not that much. So another thing you can do separate from interviewing customers is find out what your target prospect is and get better at advertising to that prospect. So small businesses, unlike large businesses, have a great opportunity to grow revenue. And a lot of it comes down to the owner's willingness to get out there and market and do sales. So you may be a fantastic salesperson and this is falling on deaf ears, and that's great. There are other business owners who feel like they're providing a valuable service or product and advertising feels like groveling. But it's really about getting information in the hands of prospective customers. And it reminds me, there's a great book by the author is Daniel Pink, like the color pink. And the name of the book that I really liked is called To Sell is Human. So that's a great book to read on growing revenue. And on this topic in general, I want to mention another book that is called Thinking Inside the Box, the 12 Timeless Tools for, I'm paraphrasing about the title, but it's 12 rules about what you need to do in business. So hopefully those are good resources for you related to this topic.
This room is going to be a problem because of that.
And if there are any questions, I can address them. This is kind of an unusual scenario because we're doing this as a recording essentially.
Yeah, Bryce, that was great information. I do have one question or maybe comment that I took out of this, which is when you were talking about your categories, when you're pulling your P&L, it's so common just to pull that category list, right? And when you were saying that, pull it by expenses by vendor, what like my ears like went, whoa, that actually is really, great to do, because then you can also look at it year over year and see what vendors are raising their rates or their whatever, and you can kind of start to compare, because many times you do have choices on your vendors. So
absolutely, that's a good point. Just compare year to year. Yeah,
that really taught me, so thank you for that.
That's great.
And then going back to when you did the focus on direct cost versus pairing like the benchmarks.
Mm-hmm.
I guess I thought that was, pretty good, but could you elaborate just a little bit on that?
Yeah, I'm glad you brought that up because I didn't mention any sources of the benchmarking. So you can find industry data. It's not the IRS, but I don't know what entity I like. The SEC comes to mind, but there are resources for benchmarking gross margin by industry, like as something to Google, that will bring up typically paid subscription resources. I want to be honest, but you can find out like I use the example of auto shop, what the typical parts and labor margin are, so that in the industry what is my target margin, and then you can determine as your specific business whether your margin can be higher or lower than the industry. So I gave the example of my father's True Value hardware store. His margins were quite a bit higher than the average because he was operating in a local neighborhood where there wasn't another hardware. This is actually before Home Depot, so there wasn't really another nearby hardware store. So everyone within a 3-mile radius would definitely go to that hardware store. So he could charge a higher margin, kind of like a 7-Eleven compared to a Safeway. I don't know if Safeway's throughout the country, but 7-Eleven compared to a typical grocery store chain.
Yeah.
The 7-Eleven is going to have much higher margins in exchange for the convenience.
Yeah. Okay. Well, good. All right. Do we have any more questions out there? All right. I don't see any. I don't see any in the chat.
All right.
So I'll go ahead.
It's been really fun. I hope it was relatable. I know I got into the weeds a bit there because I love talking details.
Yeah. So I'll just go ahead and share, my screen again, and kind of talk about some upcoming webinars that we have. You can see that we have some small some balance sheet and profit loss. Again, with Bryce, that's going to be another great one. He comes back later in November, preparing for tax time, and we have some in between there. You'll see down at the bottom there, that's our website. So you can go there to register for any of the webinars that you see, get in contact with us, schedule an appointment with one of the advisors here. And there's many other great resources for small businesses once you get there. Again, just a reminder, we are grant funded, so I'd just like to thank some of our sponsors for that. We have the SBA, the Small Business Administration, the state of Texas, the North Texas SBDC regional office, and the North Central Texas College. So thank you everyone for joining us today. Look forward to seeing you next time. Bryce, thank you so much. Some great information that you provided. And this will end our webinar today.
Okay.